Hi everyone, this is Michael Bengiant with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for August 27, 2022. Here's our disclaimer. You can pause video and read that. So this week we had a lot of changes, especially on Friday, which was yesterday, with Powell basically hitting the market hard and not giving them what they wanted to hear. So we're going to come back to that and discuss that in a little bit. But just in terms of the overall market trend, we've definitely come into uptrend under pressure. So the current market trend is uptrend uncertain. And we have a reducing exposure in the Nasdaq because we've now dropped the market count down to 4 out of 7 with 90% exposure. So Monday morning, you'd be selling 10% of the QQQ. And we've also dropped our individual stocks and non-index ETFs signal down to 15% exposure. We're just not seeing a lot of individual stocks working and more breaking down. There's really no follow through. There's not even a lot of stocks setting up anymore. So the whole picture is just deteriorated. And that's actually happened. That's been going on for a couple of weeks, a little bit foreshadowing what was to come here in the indexes. The S&P is a little bit stronger. Our action signal is just at hold because we're still at 100% exposure, but we have also dropped the individual stock exposure to 15%. And we're getting a little bit more institutional selling days here. We have 3 now in each index. So the trend has really deteriorated a little bit here. In terms of our investing strategies, we're still soundly beating the buy and hold. We did drop a little bit this week because of the plunge yesterday, but we're down 8.73%, while the QQQ is down over 22%, almost 23%. And then with the SPY, the buy and hold is down 14.66, and our system is down 9.83. So we're outperforming, which is a good thing. Let's take a look at the Nasdaq monthly chart. Now, this is something I keep coming back to. In fact, this is the big and then we had, of course, the big plunge, and we had the break above it here in 2020. Let me zoom in here, and then we have now broken back below. This shows how extended the market got. I still feel that we're nowhere near the bottom of this bear market, because when these extensions happening, even though we've only seen it once over here, but it's just the psychology of the market. It usually doesn't just come back down. It goes even lower than what you expect. So it doesn't just come to the bottom of the channel, but breaks significantly below it. So I think based on this alone, we're not done with this bear market. And from what happened on Friday, that could be happening sooner than later. But of course, we don't know. History doesn't always exactly repeat itself, but it would make sense for this to actually continue lower. Let's look at it just on the daily chart. So Nasdaq didn't even get to its 200-day moving average, which is the black line, as the S&P did. Let's look at the S&P quickly here. Yeah, it touched it exactly. That was a great selling point. Spot to have sold right when it touched there. Just means some institutions that maybe didn't get out early enough decide to get out here at a logical spot. So that was a great spot to have exited positions or ETFs or whatever. And now we've had a really pretty ugly down day, which caused some selling market count selling signals for both the S&P and the Nasdaq. So it's I would expect going forward we're going to go down to test the 50-day, which is the red line on both of these indexes. That would make a lot of sense, and how it reacts around the 50-day will probably be pretty telling. It's hard to know. We might get a big snapback rally on Monday because this was maybe an overreaction. You just never know. But we are seeing a weakening of the trend. We're now below the 21 days, which is now starting to curve over again on both indexes. You can see it over here, starting to curve over the green line. So we have to be careful. This is where the market gets tricky, and we start getting a lot more volatility. So to see a bunch of up and down days would so like we saw over here, wouldn't be uncommon, or we could just plunge. So we don't really know. Let's take quickly a look at the technicals. We actually got up to 41% of stocks above the 200, which was a major improvement, but we're starting to come back down. We're just starting to see overall a little bit more weakening. Less stocks that have broken out. The down volume is starting to appear higher. We've definitely come up. We were 11.7% of the Nasdaq percentage above the 50-day. Now we're down to 1. So he's literally dropped 10% in just about, looks like 10 days or so. So that's weakening, which would make sense. Sentiment is starting to get, we actually got up to neutral in the CNN, and we're starting to come back down a little bit. The VIX is rising. We dropped down to actually below 20, which was kind of unusual. Weekly bulls are actually increasing. They've turned bullish. So I expect if the market continues down, this will need to go back down to really ugly black levels of sentiment to really put in a bottom. But we'll see. So here's the big question. So what I talked about here is a little bit about inflation rates, inflation and the Fed. So Fed Chair Powell really sent a pretty clear message to the markets on Friday that interest rates are going to remain high until inflation goes low and stays low. So this was something the market was not looking for. They thought Powell was going to have their back, and the market was already starting to price in interest rate cuts starting in early 2023. And they didn't like the fact that he dropped his optimistic view that the Fed has a chance to engineer a relatively soft landing for the economy. So some of the things he said, this is what the market really didn't like. So he said, while the lower inflation readings for July are welcome, a single month's improvement falls far short of what the committee will need to see before we're confident that inflation is moving down. And then he said, restoring price stability will likely require maintaining a restrictive policy stance for some time. That was the one the market, I think, started to sell off when that appeared, because he was just not going to be cutting rates anytime soon. And then finally he said, we're taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we are confident the job is done. So the Fed does not want to repeat what happened in the 70s. And Powell did mention Paul Volcker, the Fed chair that was back then, in his speech. So what I'd like to do is just kind of step back a little bit and talk about what happened back then. So Volcker was the Fed chair from 79 to 87, and he's really known best for one thing. He broke the back of inflation that had really plagued the U.S. economy from the 70s until the early 80s. But it wasn't really a straight path. He didn't just raise interest rates, and that was the end of it. So from August of 79 to April of 80, he raised interest rates from about 11% to 17.5%. And inflation during this period rose from 11.8% to 14.5%. And then we had a pause in the inflation. I guess the numbers came in, looked like inflation was coming down, just like we saw recently. We had a few reports that showed inflation was down slightly. And then Volcker made an error. He started cutting interest rates. That, of course, set off a new bout of inflation, and then he was forced to raise rates again. And then by the end, we started getting stagflation. We had, slow growth, no growth with inflation. So Powell, as a student of history, he's vowed not to make the same mistakes. So during his speech yesterday, he said, the successful Volcker disinflation of the early 80s followed multiple failed attempts to lower inflation over the previous 15 years. And a lengthy period of very restrictive monetary policy was ultimately needed to stem the high inflation and start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. And then he added, restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there is very likely to be some softening of labor market conditions. So really, the Fed's going to keep at this until the economy slows down. And unfortunately, that will probably mean that people are going to lose jobs and wage gains will probably slow. But this is the cost of inflation. You have to have some pain now to avoid the greater pain of not taking any action. So the Fed kind of made this really clear that we are not going to make the mistakes of what Volker did by cutting interest rates too soon. We don't see any reason why we should be doing that. There's not enough data. And ultimately, inflation really needs to come down. That it's a bad situation if it gets embedded in the economy. It is really a huge tax on people, and of course, the ones that pay the most of this tax are the lower income and the poor. So unfortunately, I think for the market, it doesn't look likely that this is going to be a major headwind going forward, and it does look like we're going to be getting recession coming up soon, which was something the market didn't want to see or didn't want to really price in. So I think that may be starting to get priced in now. And we're seeing some signs too. First, we have several yield curves are starting to invert now, especially the 2 and the 10. And the percent of U.S. yield curves that are inverted now is at 55%. That's a level that's marked all recessions going back to the 80s. And then Ned Davis Research, they have an economic timing model. It's now below 0, and that also is forecasting a recession. So the big question is this: the market, as it's entered a bear market and sold off, and then of course rallied. The market is a discounting mechanism, and it's already been discounting all this. So the big question is this: how much has it already discounted? From Friday's yesterday's plunge, it looks like it was kind of putting in a different picture, of much more rosy picture, where we're going to see interest rate cuts and things will go back to how they were. I think Powell made it clear that it wasn't going to happen. So I expect that the market has a little bit more downside to go. And just as a final thing here, the S&P, when it gets down to about 18%, which was where it was, I think we maybe got to 20 really briefly, maybe intraday. Whether or not the S&P and the market declines further really depends on whether the economy is going to a recession or not. If there's no recession, generally at an 18% decline, the market just rebounds. So it turns out to be like a cyclical bear market within a secular bull market. And if that's true, the bottom's probably already likely in, and we'll probably back and fill down here for a bit until there's more data. Maybe we start seeing more inflation reports coming where it's really coming down a lot, or inflation could start going back up. So we don't know. But at that point, if we don't have a recession, we may have put the bottom in, and we just will kind of do nothing for a while. Now, if there is a recession, that's a different story. The 18% decline, a lot of times they turn into 20 and 30. I think 35% is kind of an average decline for a recession-induced or recession bear market. So that's the big question. It's unknown at this time. The market will kind of be telling us what it's seeing as it goes forward each day. And not good news is for stock investors, because I think generally we may not be seeing much gains in positions. But the indexes, we can still have some big, strong counter rallies, as we've seen in other charts I showed, I think last week. We've even had as much as 50% rallies within a bear market. So some of those will be tradable. But at this point, I would expect we're going to be getting lower prices in the indexes. Most stocks are going to be following that too. But of course, we follow what the market's actually doing. So we'll see. We're in that kind of no man's zone, and that's the big question: is how much is the market discounted, and we'll be finding out shortly. Okay, so that's about it for this week, and we'll be back next week with another video.